Good morning, everybody. This is Josh here at Chaikin Analytics, and this is the first session in our three-part options session. We're going to cover the basics today. We are recording this. It will be archived and available for your review later this afternoon. Before we begin, just a quick note that nothing I say should be taken as advice or recommendation to trade in any way, shape, or form. Options are risky. Please consult your financial aid, helper, advisor. All right, let's get into it. A little bit about me. I got to learn from some pretty impressive people, and really my job is to take what I've learned and just pass it along to the subscribers here at Chaikin Analytics, and at the same time helping them match the right strategy to what they're trying to achieve and give them good high probability strategies with low risk, and to help you understand what the best path is in the options market for you. So that's my job here. Hopefully we'll do a good job laying the foundation today. So we're going to talk about a stock option. And we're just going to, first, let's just talk about what is a stock option. Before we even get into any of the details and nitty gritty about it, let's just understand a stock option is a publicly traded asset. It's different from stocks or bonds or real estate or currencies. These are all types of assets. Futures, different from all of that. You can have options on all kinds of things. There are real estate options. There are options on futures contracts. You might have options on, I don't know, your employer may give you options. Those might actually be stock options. So these, though, are publicly traded. They're handled over an exchange, the Chicago Board of Options Exchange, and they are uniform. They all have some very uniform characteristics. So stock option, classic definition, is it's a contract. It's an agreement between two parties. All right. And so a classic definition is a contract that gives the buyer of the option the right, but not the obligation, to buy or sell a specific number of shares at a specific price by a specific date. It's a lot in there to unpack. We will bit by bit pull that apart. But I want you to think about other places in life where you have the choice, the option to buy something at a set price before a specific date. What else in life do we use that gives us the ability to lock in a set price for what we want to buy and do that before a very specific date? One place I can think of are coupons at the store, at the grocery store. When you walk in with a coupon, you are the owner of that coupon. What does that coupon do? Let's say it's for a pound of apples, Honeycrisp apples at the store. It's for 1 pound of Honeycrisp apples. You have a coupon for that. Well, this coupon is going to have a couple pieces of information on it. It's going to tell you the price at which you are able to buy according to that coupon. So let's say it's $5 a pound. I have no idea what apples cost. $5 a pound. And that coupon is only good for a certain amount of time. The expiration date. As a coupon owner, though, you have the right to buy a pound of apples at $5. Now, when you walk up to the cashier, do you have to use that coupon? Are you forced to use that coupon? Must you submit that coupon to the cashier because you own it? No. You have the right to hand it to the cashier. The cashier, however, if you hand it to the cashier, that person is obligated to fulfill it. They must. They're obligated. So as the owner of the contract, as an owner, you have the right to use that coupon. The person that sold it, in this case, the store, they're obligated to do it. And that concept is not much different than if we just replace a pound of apples with 100 shares of apple. And then we just change the price because you're not going to get 100 shares for $5. So let's talk about a little bit what's in this definition. We have a specific number of shares. Standard contracts, standard option contracts are for 100 shares. All right. Now, we also have something, this is a specific price. So we're allowed to buy this specific number of shares at a preset price, just like the pound of apples at the store. Specific number of shares, option contracts, standard option contracts are for 100 at a specific price. And then there's a date that we have to do it by. Now, we give these concepts, we give them names. So the price per share that you could buy Apple shares at is called the strike price. In my coupon example, that would be the $5 we're paying for the pound of apples. 100 shares of Apple, the price you would pay for them is known as the strike price. Now, the time in which the option expires is called the expiration. Pretty straightforward. The premium is the cost of the option contract itself. Think about that coupon example again. Does that coupon have a face value to it? It does. Usually it says face value is like 1/10,000th of a cent, right? So you'd have to collect quite a number of those coupons to be able to even turn them in for a penny. But they do have a face value to them. Options also have sort of a face value to them. It's called the premium. It's the cost of buying and selling the option. Option traders trade the fluctuation in the premium. And we'll talk more about that in a little bit. Now, exercising is the act of executing the option contract. It's like handing it to the grocery store clerk and saying, hey, I want those apples for this price. Right? So the exercising is the act of executing the option contract. Remember, it's an agreement. Option contracts are agreements between two parties. There's two people. There's a buyer and a seller. Now, the buyer of the option contract, that's a really important point. I think people lose sight of that, so I'm going to just back up to it. Every single share that you have, you bought from somebody sold it to you. It's the same with the options contract. There is a counterparty. There's somebody on the other side of your trade, and it is a zero-sum game. When you buy an option contract, if it goes up in value, the other side of that trade is losing the exact amount you are gaining. And we'll get more into that later. But yeah, it's very critical to, as you go through this, to understand that there are two parties. There's a buyer and the seller in this, and they have different things to consider. So an option buyer has rights. Buyers have rights. Sellers have obligations. Just like in the grocery store example, the coupon owner is the buyer in that case. The grocery store is the seller. They're the ones giving the coupons away. They're not really selling them. They're giving them away. But same thing. When you walk up, you don't have to use that coupon. But if you do choose, as the buyer with the right, they are obligated to fill it. So buyers have rights, sellers have obligations. In exercising an option, the buyer of the option contract notifies the broker. That's the middle person, right? Your Fidelities, your E-Trades, your Scott Trades, Schwabs, Thinkorswims, Interactive Brokers. They're brokers. They're the middle person. They're the ones that connect the buyers and the sellers. So when you bought the option contract, you bought it off of a seller. Your broker helped broker the trade, helped make it happen. And if you notify them, you put into motion the ability to then buy or sell the shares stipulated in the option contract. Some contracts are to buy shares, some contracts are to sell shares, but the buyer notifies the broker of the decision to exercise the option. This is irreversible. As soon as you set that in motion, that's it. You can't stop it. So as soon as you notify your broker of your decision to exercise, the broker is going to turn around and notify the seller. Say, hey, The buyer of this option is exercising it, and now you are obligated to buy or sell these shares off of them, right? And they have to do that regardless of the price for the underlying stock, regardless of the price. A buyer can execute their option, exercise their option at any point prior to when the option expires, and there's actually little rules around that. But at any point, you can buy it today and 5 minutes later tell the broker that you want to execute it. In the money, at the money, out of the money. We'll get to those concepts a little bit later as well. Doesn't matter if the strike price is favorable versus the price of the underlying stock or not. Buyers have rights they can exercise. Now, options that have intrinsic value that are in the money, they'll be exercised automatically at expiration. I had this happen to me last week. I was not paying close enough attention, and I had one that I thought I was getting out of that I did not get out of, and I just got handed the shares. And just thank goodness I had the money to buy them, but I bought 100 shares because it came to expiration and I did not exit my trade in time. So they just handed me the shares as the contract stipulated. So just be aware of that. Now, the last day that a buyer can exercise the option may not actually be the expiration date, as I mentioned a few minutes ago. Each broker has rules as to how far ahead of the expiration date on the contract they need to be notified in order to exercise the option. Exercising of options is not common. Most people trade the premium and don't actually exercise. There are situations where you may find exercising to be beneficial. And we talk about that in next week's session and the advanced sessions. Now, as I said, there are two types of stock options. There are calls. Calls give you the right to buy shares at a set price. So if you thought that Apple shares were going to go up, you might buy a call to lock in a price to buy those shares. If you own a call, again, you have the right to buy shares, which means the seller of the call option must sell the shares. Some people will sell calls against existing positions. They're known as covered calls. We'll talk about that in a little bit. But calls, the way I like to think about it is calls allow you to buy them. They allow you to bring stock to you. So they allow you to call stock in, call them in. Puts let you sell shares at a preset price. So if you thought Apple was going to drop in price, you could buy a put contract that would give you the right to lock in a price per share regardless of how far down Apple goes. It can act as insurance. A put contract allows you to sell shares. It allows you to put shares to the other party. So that's how I like to remember these option contracts. Call options allow you to buy shares. Put options allow you to sell shares. Calls call shares in. Puts put shares out. Call them in, put them out. That's how I like to remember calls and puts. Now, you have calls, which allow you to buy shares, and puts, which allow you to sell shares. And you can be a buyer of these calls, or you can be a seller of these calls. You can be a buyer of these puts. You can be a seller of these puts. The buyers are known as long. So if you buy an option contract, you're known as long that option contract. You pay the premium. Remember, the premium is the value of the option contract itself. You pay the premium immediately to whoever sold it to you. And in return, they hand you a contract. Like any other transaction in life, you give somebody money, they give you something in return. In this case, the buyer hands over money to the seller of the option contract, and the seller hands over the option contract. Now, the seller, also known as the writer of the contract, is known as short. Just like in stock, if you sell first, you're known as short shares. In this case, if you sell an option to open the position, you're known as short the option. As a seller, sellers get money handed to them, right? So as a seller, you get handed the money, and then you hand over an option contract, like any other thing in life. So buyers are known as long. Sellers are also called writers. traders, and they're known as short. So if you hear someone say, yeah, I wrote a call contract, it means they sold, they're short one call. So we have buyers and sellers, we have calls and puts. Those are the four basic actions in the options market. You may have heard all kinds of crazy names: broken wing butterflies, iron condors, vertical spreads, diagonal spreads, calendar spreads, back spreads, forward spreads, ratio spreads. Whew. There's a lot of different options strategies out there. But you know what? They all use these four basic actions. These are the only four actions you can take in the options market. So all those crazy names that we give to advanced option strategies are just combinations of these four actions. These are the only four things you can do in the options market. Now, you can buy 4 calls and then sell 3 puts, right? But you're still only doing 2 of these 4 actions. So no matter how you set it up, your options strategy, these are the 4 actions that you're going to be able to take. You can combine them in all kinds of crazy ways, but these are the 4 basic actions. These 4 basic actions have some directionality to them. If you're the buyer of a call, it means you have the right to buy shares. That's a bullish strategy. It gives you the right to buy shares, hopefully at a lower price than the shares end up being. If you sell the call, that's the other side. So if buying the call is bullish, selling a call is a bearish strategy. It's a speculation that the stock is going to drop in price. Conversely, puts, which are rights to sell shares, that's bearish. It gives you the ability to lock in a price and then put those shares to somebody else should the price drop, but you've locked in a more advantageous price to yourself. Well, if buying a put is bearish, the seller is the opposite. They're on the other side. They are bullish. So buying a call is bullish, selling a call is bearish. Buying a put is bearish. Selling a put, though, that's bullish. There's only 4 basic actions that you can take. And if you can understand these, it really helps when you start to build on them when we talk about, say, vertical spreads next week. All right? But these are the only 4 basic actions. I think people get overwhelmed by all the crazy names out there. Part of it, it's just all those crazy things. It's just combinations of this. So let's talk about premiums. Premiums are the cost of the option contract itself. And the premium will fluctuate in value. It can fluctuate for any number of reasons. It can fluctuate because of changes in the underlying stock price. So let's consider our coupon example again. Back for a pound of apples at the local grocery store, whatever you have near you. Whole Foods, Aldi, Giant, Kroger, I don't know. All right? You got this coupon. It says you can buy a pound of apples for $5 a pound. And you walk into the store and they're selling apples right now for $10 a pound. And you think, wow, I can save $5 on this. That's pretty good. I can lock in a price of $5 for this pound of apples. And then let's say I walk up next to you and I also look at these apples and I go, oh man, $10 for a pound of, I don't want to pay $10 a pound of apples, but I really want these apples. I wish there was a way I could lock in a better price. You might turn to me and say, hey, I got a coupon that gets you for $5. I'll sell it to you for $3. How about that? That way you get apples for $5 a pound minus the 3 you gave me. You'd be able to sell that coupon, right? Now, if apples were going for $20 a pound, you could probably sell that coupon for more than $3, couldn't you? And if there was a big apple panic and apples were selling for $100 a pound, well, you definitely could sell it more than if apples were only $20 a pound. So changes in the underlying, in this case, a pound of apples, can change the value of that coupon or that stock option. Now, one thing that doesn't translate over into the coupon example is time value. These options have a time value associated with them, and they will lose that value every day. So that can affect your premium as well. And then premiums can also fluctuate due to changes in volatility. If you've ever heard of the VIX, The VIX is the volatility index. It's a very specific volatility index. We talk about it a little bit more next week. But when that moves and when volatility moves, the premium will change. And you have to be aware of that as well. So we talk a lot about implied volatility and volatility and how that affects premiums next week. It's an important concept. Right? So the premium, again, it can move for a number of reasons. Not always related to the stock price. I've had people call me who said, hey, the stock didn't go anywhere, but I've lost money. Or, hey, I'm making more money, but the stock went down a little bit. I don't understand. Well, it's probably because one of the other things happening, time value changes, decay, or volatility changes. They're moving parts. We talk a lot about those moving parts next week. The first half of the intermediate session talks a lot about the theoretical Greeks and things in the option contract that cause it to move. Now, your premium is made up of two parts. We don't really see those when you open up your options chain. They just show you what the last price of the premium is. But a premium really is composed of two different values. One is called intrinsic value. The other is known as extrinsic value. When you add these two together, you get the value of the premium. Now, intrinsic and extrinsic value can move independent of one another. And it's often beneficial to understand how much intrinsic or extrinsic value you have in a trade. There's a pretty simple computation to determine your intrinsic and extrinsic values. Now, your intrinsic value is the value of that option if you were to exercise it right now, currently. It's sort of like the face value. So in the coupon example, if you had a coupon for a pound of apples for $5 a pound, and they were selling for $10 a pound, you could realize a $5 savings right then and there. So we'd say that's your intrinsic value. In stocks, we do a similar math. We say, all right, what's your strike price? Well, if you have a strike price of 145, and Apple stock is currently trading at 150. If you exercise that option and bought Apple shares at the strike price, you would pay $145. You could then turn around and sell them on the market at 150, realizing a gain of $5. That's your intrinsic value. So for calls, what we do is we take the current stock price and we just subtract the strike in the contract. All right? If the strike price in this example was 150, our intrinsic value would be nothing. Apple is trading at 150. We have the right to buy at 150. If we exercise that contract right now, we would not make or lose a penny. That's how that works. Now, once we have the intrinsic value, we can calculate the extrinsic value pretty easily. For puts, we take, for the intrinsic value, for puts, it's just the other way around. We take the strike and we subtract the stock. So for calls, we take the stock price and subtract the strike. For puts, we take the strike price and subtract the stock price. And that tells us what our intrinsic value is. Remember, with puts, it enables us to put shares to people at a preset price. So if I own a put, which allows me to sell Apple shares, and the strike is at 155, it means I can sell, whoever sold this put to me, I can sell Apple shares to them at 155. And Apple's currently trading at 150. I have a value of $5, an intrinsic value of $5. Because if I went out in the open market right now and bought up 100 shares of Apple at $150 and then turned around and executed that put that is a strike price of 155, I could immediately realize a $5 gain. So your intrinsic value tells you the difference between the current price and the strike price. All right? Intrinsic values cannot be negative. They stop at 0. They're going to only be positive. They can't go against you. Now, again, once we have the intrinsic value, the extrinsic value is easy. We just take the premium, we subtract the intrinsic, and we get the extrinsic value. The extrinsic value is subject to time decay. Intrinsic values are not subject to time decay. Extrinsic values are subject to time decay. They're subject to changes in volatility. They're subject to the underlying changes in volatility and time decay. That's it, right? So, but the intrinsic is not. The extrinsic is. So it's good to understand how much extrinsic value you have. The amount of extrinsic value you have often will determine your odds of success in a trade, in a very simple directional trade. Right? So that's intrinsic and extrinsic value. Right? Let's talk about break-even numbers. All right. So the strike price is the price at which you can buy shares, or with a put is the price at which you could put shares to people. That's the strike price. But because these option contracts have a cost to them to acquire them, our break-even number, the point at which we profit, isn't the strike. It's the strike plus what we paid for it. For a call or for a put, it's the strike minus what we paid for it. So if I have a strike, I'm able to call in shares at $10, right? And I paid $1 for that. And let's say the shares only go to $10.50. Well, at expiration, I'll have an intrinsic value of 50 cents, all right? Because I'm at $10.50, so I'm 50 cents above my strike. But I paid $1 for this. So I didn't make enough money to cover my costs. I would actually lose 50 cents on that trade. My break even in that scenario where the strike price is 10 and my premium is $1 means my break even is really 11. I need the stock price to go above 11 for me to profit. Now, break even prices refer to your profit loss line where you would make or lose money, the dividing line between profits and losses at the expiration time of the option contract, not before. The break-even price prior to expiration is different. We'll get into that in a few minutes. Break-evens refer to your price at which you make or lose money, the dividing line between profits at expiration. All right, so break-even is the dividing line between profits and losses at expiration. Now, I've thrown around some phrases: in the money, at the money, out of the money. You may have heard these thrown around before. Sometimes, by the way, you will see people will not hyphenate. They will acronym these, not acronym. Sometimes you'll see these as ITM, and you might see at the money abbreviated as ATM. ATM is not in this case where we get our money necessarily, but it is at the money, and then you'll see this be out of the money, OTM. And so sometimes you'll see those shorthands used for in the money, at the money, and out of the money. Now, in the money means the option has intrinsic value. So for calls, it means the stock price is above the strike price. And for puts, in the money means the strike price is below, the stock price is below the strike. At the money is when the strike price is at or close to the strike. And out of the money is when if you were to exercise the option, it would be worthless. And in the cases like that, that's when your calls where the stock price is below the strike, which means the stock price is currently below your price that you've locked in to buy it at. All right, be out of the money. That would be akin to walking into the grocery store with a coupon to buy a pound of apples for $5 a pound, and the store's selling them for $3 a pound. And that coupon is out of the money. All right, you wouldn't use it. You could buy it cheaper right there in the store without the coupon. That coupon would have no intrinsic value either. So we tie those concepts together. So for puts, Out of the money means the stock price is above the strike price. Now, on the right, I have an abridged option chain. I took a snapshot of the options chain on the Fidelity platform. All right. I have an account with Fidelity. And so I just took a snapshot of the options chain there. And it's not the full options chain. There are a lot more columns that go into it. We go into all of that. It can be overwhelming. If you've ever stared at an options chain, it's a lot of numbers in rows and columns, and it's not easy to sort of dissect. Next week, we go through them column by column. But I did want to point out a few basic things. So first, you'll see the strike price is listed right down the center. All right, so here are the strikes. Now, each strike price is its own individual contract, which means it has its own premium value. The premium is the last price. Just like in a stock, they give you the last tick. This is the value of the calls. The calls are on the left. And this is the value of the puts. So I can look at the 242 strike and say, okay, if I wanted to buy a put for 242, it would cost me 240. If I wanted to buy a call at 242, it would cost me $1.55. Now, unlike your stock, we have to be aware of the difference in the bid and the ask. We talk about this more next week. The bid is just what the buyer is saying they're willing to pay. The ask is what the seller is saying they want to pay. We talk more about that next week. You'll also notice that there are some shaded sections. Fidelity does this, and I believe all platforms do this. You might be able to toggle this feature on and off, possibly, but I'm pretty sure all platforms do this. My Thinkorswim platform does it as well. It shades the in-the-money options. So you can very quickly and easily find the in-the-money versus out-of-the-money options. For the calls, all the ones in the upper left there of the chain, options chain, are in the money. They're shaded blue. And the puts are in the money, shaded blue on the bottom right, which tells me that if this strike is in the money, this is the dividing line. That means that the current price is somewhere in here. Somewhere in there is where the current price for this this equity. I pulled this off of the S&P, the SPY, the ETF. But it tells me where at the money is. It tells me that at the money is around 241.5 or 242. And in the money are when the calls are where the price is below. So these are all the in the monies. And for puts, in the money is where the stock price is below the strike price. All right. So if the stock price is at 241, if the stock is currently trading at 241, that means that anything below, stock price below the strike would be in the money. All right. Here, we know that it's trading around 241.5 to 242 because if the stock price were 241, this would be in the money also. And then these calls would be out of the money and the shading would change. They would just move the shading up for me. All right. So it's a very quick visual way. Options change will do this. It's a very quick visual way to tell you what's in the money or what's out of the money. And in this case, what's shaded is in the money. Very simply, if your option is in the money, it has intrinsic value. And if it's out of the money, it has zero intrinsic value. Right? In the money, intrinsic value. Out of the money, no intrinsic value. Now, let's talk briefly about the risk and reward basics. And I do mean basics. Options are leveraged. They allow you to take a small amount of money to control 100 shares. And they have different risks and different reward profiles than just buying shares of stock. If you buy a call, you're long a call, which is bullish, you buy a call, your risk is limited to the amount that you pay for that premium. Your reward is unlimited. How does that work? Well, let's say you pay $1 to buy an option with a strike of 10. Okay, so we buy a call option and we pay a premium of $1, and we have a strike price of 10. All right. So that means we have the right to buy shares at $10 a share. Okay. We paid $1 for this, which means our break even is what? $11. The stock price has to rise above that. Now, if we have the right to buy shares at $10 and the price of the shares goes to $15, we have the right to buy it at 10, it goes to 15. We're in the money. That's awesome. We've made some money here, right? Now, you'll see it says my reward is unlimited. Why is that? Well, how high could this price go? How much money could we make on this? Could it go to 20? Go to 30? Could it go to 30,000? Could it go to 30 million? Right? In theory, a stock price can go up infinitely. So if you buy a call, it can go up infinitely. So we say that the reward is theoretically unlimited. Now, your risk is the amount you paid. Let's say you buy this call option for $1 with a strike price of 10, and the company goes bankrupt. Their shares go to 0. Well, you have the right to buy shares at 10. You're not going to do that because they're worth nothing. You paid $1 for this. You can't lose more than that $1. It's impossible. You paid $1 for it. The contract's worthless. The contract's worth 0. That's it. You lost the $1. So when you buy an option, your risk is limited to the price you pay for it. That's the most you can lose. And your reward with a call is unlimited. Now, let's think about this with a put. All right. Let's move this down here to the put side. All right. We still pay a premium for that put, and the strike price is 10. So if sorry, let's back up. Let's not talk about puts. Let's talk about the other side. So if you buy it for $1, you pay $1 and it goes down to nothing. You lose that $1. If it goes up to $1 million, you make, $1 million minus the strike and the premium. Quite a good trade. Now, the person who sold it to you, the person who's short, the most they can make is that $1. That's what they got paid up front. You're not going to hand them more money down the line. So the seller, the option seller, their reward is limited to the price we paid, just like our risk is limited to the price paid. Remember, this is a zero-sum game. So whatever our risk is as a buyer, that's the reward for the seller. And whatever the seller's risk is, that's the reward for the buyer. Right? So this risk is the same as that reward. Now, that means that the reward is the same as this risk. So a short call has, in theory, unlimited risk. A short call, you sell a call, means you're obligated to buy shares. Well, if you're obligated to buy shares at $10, and it goes up to $1,000, well, that's not good. I just bought them off you for 10, so I can go and sell them for 1,000. You got to sell them to me, though. You got to give them to me at the price, no matter how high it is, and you lose the difference. So just like the long call makes money as high as the price can go, the short call, which is bearish, loses money as high as the price can go. There's one caveat. Uh, the short call, instead of losing the money itself, can be covered shares. So if you sell a call and you own enough shares, they'll just unload your shares at that price rather than take the money out of your account. If you're naked and you don't own the shares, then you're on the hook for the dollar amount. Covered call is where we sell a call and already own the shares. So it's still a bearish strategy. You can have your shares taken away from you in that case, but you don't lose quote unquote money out of your account with a covered call. If it goes against you, your risk is you lose the shares, not the actual dollars. All right, now let's talk about puts. So back to my little example, if we pay a premium of $1 and the strike price is 10, right? $10 a share. If we're long the put, the most we can lose is the premium. Same like with the long call. When you buy options, the most you can lose is that premium. That's your risk. Your risk is the premium. So any debit strategy you do, that's what's going to happen. I just realized I threw a phrase at you that I haven't mentioned yet, which is debit and credit, which I need to add into the long and short conversation. If you put out money for an options trade, it's known as a debit trade. If you take money in, it's known as a credit trade. So if you're long and you just buy a contract, you don't do anything else, you buy a single contract and you're long and you're the buyer, that's a debit strategy. You can only lose the amount you pay out, right? So whether it's a long call, long put, you're limited, your risk is limited. This is how you're able to take low risk trades for big reward. With a strike of 10, the only difference in terms of maximum reward between the put and the call is a price of a stock can in theory go up forever. So with a call as the right to buy it, you could buy it lower and have that price just keep rising infinitely in theory. So we say that your reward on a call is unlimited. With a put's the right to sell shares at a set price. So we have the right to sell shares in my example at $10 a share. Well, if I have the right to sell you shares at $10 a share, I can only profit as low as the stock can go. And because stocks can only go to zero, the maximum reward on any long put trade is the difference between your break-even price and zero. That's the most you can make out of that trade. All right. The put seller, just like the call seller, is on the other side. Their reward is limited to the premium that they receive, the dollar. Their risk, however, is everything between that break even and zero. In this case, that would be $9. So they have a reward of $1 and a risk of 9. A lot of people at this point become a little puzzled about that. Why in the world would I want to take in $1 as a maximum reward, but expose myself to $9 of risk? Wouldn't I much rather buy it for $1 and expose myself to the potential to make $9 of profit? Well, the thing is that the odds of success are different for the short seller and the long buyer. Let's talk a little bit about that. If you buy a call, you have high reward and low risk, right? You can buy the call for a low premium, and then the option can go up, 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 and you can make a lot more than what you paid in that premium. However, the person who sells this to you has better odds than you do of profiting. Even though they have lower reward, they only take in the premium, and they have higher risk. They're at risk as high as the stock price can go. They have higher odds of success. Let's think about why. If you buy a call and the price goes down, will you make money? No. Call is bullish. Buying a call is bullish. You need the price to go up for you to profit. You cannot profit if the stock price goes down. Now, if you sell a call, which is bearish, you profit if the price goes down, and you lose money if the price goes up. Now, I don't know if this has ever happened to you, but sometimes the price doesn't really go up or down. It kind of goes sideways. Now, if the price goes sideways, the call buyer will not make money, but the seller will. So there are pretty much three things a stock can do. A stock can go up, a stock can go down, and a stock can kind of zigzag, kind of go sideways. As a buyer, you only profit with one of those directions. As a buyer, you only can make money off of one of these directional moves. With buying a call, you need it to go up. If you buy a put, guess what? You need it to go down. And if you sold the put, buy the put, need it to go down. If you sold the put, you make money if it goes up, but you also make money if it goes sideways. So you see, the seller can profit from either the directional move in their favor or no move whatsoever, whereas the buyer only can profit when it makes a move in their direction. They have lower odds of success, but they have much bigger reward for that odds of success. I like to use the example a little bit of and this is an extreme example, but I think it kind of paints the picture. Think about the Powerball lottery. I live in Pennsylvania. I have the ability to pay Powerball. When I go and I buy that Powerball ticket, right, I'm the buyer of that. What's my risk? It's $2, right? Not a lot of money, honestly. If I lose that $2, it will not change my lifestyle. Now, what's my potential reward? Millions, hundreds of millions, right? As a buyer of a lottery ticket, you have very, very, very low risk, very, very, very high reward. Sounds like buying an option a little bit. But what are your odds of success for that sort of risk-reward profile? What are the odds I'm going to win the Powerball? Not great. Now, again, it's an extreme example, risking $2 to make millions with very, 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 very low odds of success. But the seller of it, think about the other side. So the Commonwealth of Pennsylvania sells me this lottery ticket. What is their reward? Off of me individually, they only make $2. That's all they make. They make $2. It's not a lot of reward. What do they risk? They risk having to pay me millions of dollars. Commonwealth of Pennsylvania doesn't want to do that. But what are the odds they're going to have to pay me millions of dollars? So slim. So as the seller, they have very high odds of keeping my $2 and very low odds of paying out that big amount of money. Options, similar, not as such an extreme way, but similar. If you're the buyer, you have lower odds of success, but you also have lower risk and higher reward. If you're the seller, you have lower reward and higher risk, but you also get higher odds. There are all kinds of strategies where you can pull on these different levers. There are strategies where you can increase your reward and decrease your risk. As you do that, though, your odds go down. That's it. If you pull on those two levers to push them where your risk goes down and your reward goes up, your odds are going to go down. On the other hand, if you push the risk lever up and accept a little less reward for that, guess what? The odds lever is going to go up also. What you cannot do in the options market is lower your risk, lower your odds, and increase your reward all at the same time. The levers just don't move like that. But you can decide, hey, I really would rather have higher odds of success. And as you push the odds of success lever in your favor more, as you push that odds up, automatically the other levers are going to move. Okay? And it's a balance, and you have to find where you balance between how much you're willing to risk, how much you think you can make off of that trade and what your odds of success are for it. Let's get into a couple quick examples that I just thought up off the top of my head. I invented these out of thin air, but I just want to walk through them. We're going to go through two quick examples. Any questions you have, please, there's a Q&A window. Ask any questions you have. We'll wrap up in about 5-10 minutes. First, let's talk about a call option example. So let's break this down piece by piece. First, we are buying, so we are long. Next, it says we're buying one, so that's our quantity. It says one contract, and this tells us the underlying stock, which is Apple. All right, so we are long one because we're buying. The underlying is Apple. Next, we have a date, December 31st. That is our expiration. All right. Next to our expiration, we see the number 200. That is our strike price. That tells us that we are able to either buy or sell, I don't know yet, at 200. Now I know. It's a call. Calls allow me to buy. So I am long one Apple call with an expiration December 31st, and I can buy Apple shares at 200 per share. Now, for that, I'm going to pay $1.25. That $1.25, that's our premium. So the buyer of this pays the seller $125. When we talk about premiums, the actual cost of a contract is the number of shares in the contract multiplied by the premium. Standard options are for 100 shares, so we take the premium and multiply it by 100. And this is common all over. If we just go back to here, all these last prices, the premium, the cost for these are multiplied by 100. So if I wanted to buy the at the money call, which would be one of these two, we'd say those are at the money, it would cost me either $185 or $155. Remember, we're going to take the premium and multiply it by 100, and that tells us the true cost to us in placing that trade. All right. Now, we pay out $125, which means our break even is what? To calculate break even, we take the cost of the premium, we add it to the strike. So we take 200, we add 125 to it, and that tells us what our break even is at expiration. So we need Apple to close above $201.25 in this example to make money at expiration. If Apple's below 200 at expiration, the option expires worthless. Right? It's like you walk into the store with a coupon for $3, for $5, and they're selling them for $3. Coupon's worthless. You're not going to use it. Same thing here. If you have the right to buy Apple at $200 and it's currently trading at $190, you would never use that contract because you can just go on the open market and buy it for $190. So if Apple is above 201.25 at expiration, you would profit from this call example. This would be a speculative trade that would profit if Apple goes up. Right? That's what this is. That's what this example is. The put example, oops, before we get into that. All right, so we profit if it's above 201.25 at expiration. We represent our ability to profit based off of what are known as profit and loss graphs. All right, you may have seen these before. We talk more about them next week, but they tell us very quickly where we make money and how much. The stock price is represented on the x-axis. Down is lower, this way is higher. So if you're long a call and the price goes up, right, that's good. Your profit is represented on the y-axis, the vertical axis, right? So if the price goes up, then you profit. If the price goes down, you lose money. Now notice that your losses are fixed, right? This green area keeps getting bigger. This red area, it goes down, 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 and then all of a sudden you stop losing money. That's the most you can lose at flat lines. Why? Because that red area represents that premium. The premium is the most you can lose as the buyer. Now, as the seller, what's the premium? The premium is the most you can make. And this area right here, that little red area right there, and this green area right here are exactly the same to the penny. Exactly the same. Whatever the long call is making, the short call is losing, and vice versa. Which means that this green area here is exactly penny for penny the red area here. Long calls profits, short calls losses, and vice versa. The curve line includes time values and volatility values. I'm just going to ignore the curve line for now. Okay? But if you ever see this, you can tell very quickly, one, where your break even is. That's where it changes over. That's our break even price. And it's the same. That price is the same for both people here. This number here, whatever this number here is exactly what that number there is. Those are the same numbers. Okay. So that's a profit and loss graph for a call. For a put, same basic thing. Let's say we thought Apple was going to, I don't know. Let's say we thought Apple was going to go to zero. We thought Apple was going to go bankrupt. iPhones, they're going to become so passe. None of the kids like them anymore. That's not true. All the kids, I was at the Nutcracker, and all the kids that were dancing in it had their iPhones out behind the stage. They love it. But let's just pretend that we think it's going to go to zero and the kids hate Apple. We might want to buy a put that would enable us to lock in a price to sell shares at. So in this case, we would buy one Apple, right? Underline for Apple, December 31st put. Means that we have until the 31st for this trade to work out for us. 100 is our strike. Put tells us that we have the right to put shares to people. And for this, we're going to pay also $1.25. Now, we pay the seller $125. And now for us to make money, Apple needs to go below 98.75 at expiration. That's our break-even number. We calculate that again by just taking the strike. And for a put, we subtract the premium. With the call, remember, we added the premium to calculate the break-even. With a put, we subtract it. If Apple is above 100 at expiration, the option will expire worthless. It will not be exercised. It will just expire, be worthless, and go away, dissolve, cease to exist. Right? Now, if Apple is below 100 at expiration, the option will automatically be executed. Just like happened to me this past week. Right? I had a call option. Stock went up. I didn't unload it. I got handed shares. And I had to pay for them. I had to pay, whatever the number was per share. In this case, if we had to buy 100 shares, we'd have to buy 100 shares at $100 a share. We would need to have 10 grand sitting in our account in order to buy all those shares. In this case, we'd be putting the shares out. So it would be short 100 shares at 100. So it'd be short with a 10K, you need margin. But that's how that would work. Right? And then the profit loss graph for this looks very similar. We just flip them around. In this case, because a put is bearish, If you're long a put, you make money as the price goes down. Remember, the horizontal axis, the x-axis is the underlying price. So as the price goes down when you're long a put, then your profit and loss are on the y-axis, your profits go up. If the price goes up, well, you lose money for a certain amount, and then it flatlines. So you start losing more and more and more and more, and then eventually your option is just worthless. This represents option being worthless, maximum loss. Your entire premium's gone. And that's the case regardless of how high the price goes. Again, what you see on the left here is the exact opposite of what is going on at the right. So the area here where you see losses, that is exactly penny for penny the short puts profits to the penny. And those break-even numbers are the same. Where the long put buyer makes or loses, that dividing line there is exactly the same as where the seller, the short put, the writer of the put, also makes or loses money. In theory, you both, the buyer and the seller, could come out flat. Neither of you make nor lose money. That's very rare. Don't count on it. All right. So that is your profit and loss graphs for puts. So just a quick review. Strike price, that's the price per share of the underlying asset that this option contract refers to. The expiration is just the last day that we can trade it. It's not the last day that it can be executed. It's the last day we can trade it. Premium is the price of the option. It's what we trade, the value we trade. If you're long and the premiums go up, you make money. If you're long and the premiums go down, you lose money. Vice versa if you're short. We trade the premiums. And then exercising is just the act of executing the terms of the contract. It's a put contract with a strike of 100. If you exercise it, as the owner of that contract, you have the right to put shares people at 100. That's exercising and execution. Calls are contracts to buy. Puts are contracts to sell. Call them in, put them out. Call in shares, put out shares. Contracts to buy, contracts to sell. Now, buyers are long. Buyers have rights. Sellers are short. Sellers have obligations. Buyers have rights. Sellers have obligations. You can have an option executed on you before expiration at any price if you are short. You can also, we'll talk about this more next week, you can have one part of your option contract executed against you if you do a spread. So let's say you buy one and you sell one. Well, the one you sell, you're obligated, if it gets executed, to assume the terms of the contract. It's rare, but it's something you should be aware of. Anyway, buyers have rights, sellers have obligations. Next week, we're going to talk about specific strategies: calls, buying calls, selling calls, buying puts, selling puts, and we're going to pair them with best practices in terms of Chaikin analytics. When do we want to buy a call? What kind of stock do we want to buy calls in? When do we want to sell a call? What kind of stock should we be selling calls in? That sort of thing. We'll cover that next week in our intermediate session. Now, inside of options play, or inside of Chaikin Analytics, is something called options play. It's a great tool. I use it. I love it. It has really helped me visualize some things that, listen, options chains, there's a lot of numbers on them. And what I used to have to do, on pen and paper, and options play does it for me, a lot of that stuff. So it does a lot of the calculations. It lets me compare different strategies right against one another. They have a scoring system. That's their scoring system. Anyway, you can learn all about that options play tool in Chaikin Analytics. We have a tutorial video on it. If you go to the Resource Center and you scroll down, you'll see a little button that says View All Tutorial Videos. And if you click on it, it'll take you to our full tutorial playlist, where you can then watch the options play walkthrough. I did it a couple weeks ago. I would love feedback on it. I got some great feedback in the info box today I don't know when it came in. I saw it this morning about the Greeks inside of the way the Greeks are explained inside of options play. It was great feedback. I love that. Please send me more. So next week we will do the intermediate session, 11:30 to 12:30, same time, same station. Please, if you have any questions, you need anything, send us an email, support@chaikinanalytics.com. I or one of my colleagues qualified to answer your options questions. We'll get back to you as soon as we are able. All right, kind of first come, first serve. Sometimes it's real easy for us. There's not a lot coming in. We can knock out answers, get them back out to you real quick. Sometimes we get flooded with questions. Takes us a little bit longer on the turnaround. But please send us your questions. If you have questions on something, send it to us, or you can call us. And if you don't reach us immediately, please leave a voicemail. But please reach out to us with any questions you have or any feedback you have on this session. I appreciate everybody's time. We did record this. It will be archived and available to you later this afternoon. I thank you all for attending, and I look forward to hanging out with you hopefully next week in our intermediate class. Have a great day. And Merry Christmas to those of you celebrating Christmas out there. Happy Hanukkah. Happy Kwanzaa. Happy holidays to everybody, and I look forward to seeing you on the other side.